Hello. In this video, we will walk through an example of a master budget process. This is case 9-29 from the textbook Managerial Accounting by Garrison, Libby, and Webb, the 11th Canadian edition, published by McGraw-Hill, Canada. The case has been adapted, so it's not exactly the same as the one that appeared in the 11th edition of the textbook. Now, for an optimal learning experience, I would suggest that you download the case information, which is in the form of a PDF file. And if you prefer to work along with me, then you would also want to download the solution template, which is in the form of an Excel file. So this case is about a manufacturing company, a maker of a special chemical compound called compound WX. And we've been given information about the operations for the first quarter of 2022 and other related information. And we'll come back to the information in a bit. It's always a good idea to take a look at what we've been asked to do. We've been asked to prepare the following budgets for each of the first 3 months of 2022, a sales budget, a production budget, a raw materials purchase budget, direct labor and manufacturing overhead budget, selling and administrative budget, and then finally a cash budget. Okay, so we'll get started with the sales budget. So for a sales budget, we need basically two types of information. We need how many units the company is forecasting to sell in the months of January, February, and March of 2022. So the number of units are provided to us in the case. We can use those number of units. And we've been given the selling price, which is $75 per unit. It was the same price in 2021, and it's not expected to change in the first 2 quarters of 2022. So with that information in mind, we can set up our sales budget. Now, we've been asked to prepare the sales budget for the first quarter. So we'll have numbers for each month and then a column for the total. Estimated sales in units. We've been provided with that information, 11,000 for January, 10,000 for February, 13,000 for March. And we've been provided the selling price of $75 per unit. So we go ahead and take the number of units, multiply it by the selling price of $75 each. Now watch out for a tendency. Sometimes people will mistakenly, just because we had added together the number of units sold in each month, sometimes I see students just mistakenly add the selling price of each of the 3 months. Now that wouldn't make sense. Our selling price for the quarter cannot suddenly become $225. So watch out for those errors. And then go ahead and multiply the number of units with the selling price per unit, and we get our sales budget. The sales for the month of January are estimated to be $825,000. For February, $750,000, and for March, $975,000. For the entire quarter, sales are budgeted to be $2,550,000. Now, I recommend that as you do the sales budget, also calculate how much of cash we will be collecting from customers. This is an important component of the cash budget. And if we go and read the information provided in the case, in additional info number F, we're told that credit sales are 60% of total sales. So that means 40% of the sales are made on a cash basis. The remaining 60% are credit sales. The company collects 70% of the credit sales during the first month following the month of sale. So if you had any sales in January, 60% of the sales of January would be made on a credit basis. And of that amount, 70% will be collected in the following month, which is February, and 27.5% during the second month. So the second month following January is March. And what about the remaining 2.5% of all credit sales? Well, these, we are told, end up being written off as bad debts. So 2.5% of all credit sales end up being written off as bad debts. It basically represents an amount that we are not able to collect from our customers. So let's take a look at what our collection pattern is. Since 60% of the sales are credit, the remaining 40% are cash sales. So in the month of sale, we collect 40% because that represents the cash sales amount. The next month, we'll collect 70% of the credit sales, which happen to be 60% of the total. So 70% of 60% results in 42% of the total sales value being collected. Similarly, the month after, we collect 27.5% of the credit sales. Because credit sales were originally 60% of the total sales, this amount works out to 27.5% of 60%, and that is 16.5% of total sales. Bad debts, 2.5% of credit sales, is 1.5% of the total. And we can check the sum of all these percentages should give us 100%. So these amounts are all percentages of total sales. In the month of sale, we collect 40% of total sales value. In the next month, we collect 42% of the total sales value. In the month after, we collect 16.5%. The remaining 1.5% never gets collected. So how does that work out for us? For January, if you think about the month of January, total sales in the month of January are going to be $825,000. Out of that, 40% will be collected in January itself. So 825,000 times 40%, in the month of January, we will collect 330,000. Look, 825,000 times 40%. We'll collect that amount in January itself. In the next month, February, we will collect 42% of 825,000. So 42% of $825,000 gives us 346,500. In the month of March, we'll collect 16.5% of 825,000. So that works out to a total of 136,125. In a similar vein, for the sales that occur in February, $750,000, 40% will be collected in the month of February itself. 40% of 750. 42% of 750,000 will be collected in the month of March. And the remaining 16.5% will get collected in April, but we are not making a budget for the month of April, so we skip that. For March, similarly, 40% of the sales in March, 975,000, will get collected in the month of March itself. So 40% of 975,000, that's $390,000. Now, it's an interesting pattern to note. We consider what happens in March itself. We're collecting 40% of sales that took place in the month of March. We are also collecting in the month of March 42% of sales that took place in February, because March happens to be the month following February, I meant. March is the month following February, and so we collected 42% of the sales that occurred in February. And then thirdly, in the month of March, we collect 16.5% of the sales that took place in January. The remaining 1.5% don't get collected, and that's bad debt expense. But what we should notice here is that in every month, there are three amounts that we are collecting. A certain percentage, 40%, for the sales that took place in the current month, 42% from the previous month, and 16.5% from 2 months prior. So if this pattern does hold, then for February, we must have collected 40% of February sales, 42% of sales made in January, but then there has to be a 16.5% collection of sales that took place in December. Now, sales that took place in December were a total of 12,000 units at a selling price of $75 per unit. So of that amount, 40% must have been collected in December. 42% must have been collected in January, and then 16.5% in February. So we're being alerted that not only do we have an amount relating to December being collected in February, we should also have an amount, the 42% of the sales that took place in December would have been collected in the month of January. And so completing this 3-monthly pattern, for sales that took place in the month of November of 2021, the number of units was 10,000 there at a sale price of $75. 40% must have been collected in November, 42% in December, both of which relate to the previous year, and then the remaining 16.5% must have been collected in the month of January. So in the month of January, we should have 16.5% for sales that were occurred in November. So 16.5% of November sales, that gives us 123,750. Now, if we add these up vertically, we get the amounts that were collected in each month. So in the month of January, we expect to collect 831,750. It's not the same thing as the sales for January. The collection pattern means that we don't collect the same amount in dollars or cash. In February, we're expecting to collect 795,000. And in March, we expect to collect 841,125. The total collected is 2,467,805, and that should correspond to the sum of these monthly amounts. So our collections that will take place during the first quarter will include 16.5% of November sales. They will include 42% and 16.5%. So that's a total of 58.5% of all sales that were made in December. We'll collect 100% of all sales that are made in January in the current quarter. We will collect 40 plus 42, 82% of sales that are to be made in February, and we shall collect 40% of the sales to be made in March. And the sum is 2,467,875. Once we have prepared our sales budget, the next budget in line is the production budget. And the production budget needs the estimated unit sales that will be made during the period of time. And this company, we are told, produces enough units each month to meet that month's sales, plus a desired inventory level equal to 20% of the next month's estimated sales. So that's the concept of keeping a safety stock. So this company does not want to take the risk of ever ending up in a situation where they run out of stock to sell. So the company management would like to play it safe and maintain an ending finished goods inventory level of 20% of the following month. So what does that mean? When we determine how many units are to be produced, our starting point will be the estimated sales for each of the months. In our production budget, that's what we start out with. Our estimated sales in units are 11,000, 10,000, and 13,000 respectively. But we've been told that the company wants to maintain an ending inventory, so that's our required ending inventory, equal to 20% of the next month's sales. Now, for January, the next month is February. In the month of February, we are expecting to sell 10,000 units in total. 20% of 10,000 or 2,000 units is how much we need the ending inventory of finished goods to be for the month of January. So in the month of January, the total number of units that we need to be available is 11,000 units that we expect to sell, plus 2,000 units that we require to hold in our ending inventory. So that adds up to 13,000 units. Do we need to produce 13,000 units? The answer is, well, no, because we must have begun the month of January with some amount of units on hand. Now, in the case we were given that finished goods inventory at the end of 2021 consisted of 2,200 units, right? End of 2021 was December. So we must have ended the month of December with 2,200 units. Now, say if this information wasn't given for some particular reason, can we infer how many units? Well, if we think about the company management applying their policy on a consistent basis, well, then December was the month preceding January. And if the company's management insisted on ensuring 20% of the following month's estimated sales, then they would have ended the month of December, right? So in the month of December, if you think about it, the company sold 12,000 units, but they would have also made sure that they had on hand 20% of the estimated sales in January, right? So that is where we could have calculated the beginning inventory for January 4 if we were not provided with that information. So just, 20% of the estimated sales in January will have been the beginning inventory for the month of January. Okay, so if we require a total of 13,000 units of finished product for the month of January, and we have 2,200 units on hand already, it is the difference between the units required and the units on hand that gives us the number of units we must produce. So January, we need to produce 10,800 units. If we look at the month of February rather, February, the estimated sales in units is 10,000. We want to maintain an ending inventory equal to 20% of the sales for March. 20% for the sales in March works out to 2,600 units, which gives us a total number of units required, 10,000 to be sold, and 2,600 required ending inventory, 12,600. Since we would have begun the month of February with 2,000 units on hand, the 2,000 units is really the ending inventory coming down from January. The 2,000 units already on hand means we only need to produce the difference, 10,600. And on and on. We go on to March. March, we have 13,000 units that we expect to sell. We need our ending inventory for March to be equal to 20% of the sales to be made in the next month. Now, the month following March is April, and in April, the company expects to sell 12,000 units. So April, we expect to sell 12,000 units. We want to maintain an ending inventory of 20% of 12,000, and that's 2,400. Add them up, you get 15,400 units is the total number of units required for the month of March, of which we already have 2,600 units on hand. The difference is what we need to produce. 12,800 is the number of units that we need to produce in the month of March. Now, when we're doing the totals column, we got to be a bit more careful. So agreed that in the quarter, January through March, we're looking to sell a total of 34,000 units. Now, a very common mistake that students make is that then once they've input the formula, they just drag it down. So what happens if you drag down your formula is that you get 7,000 units as being the required ending inventory. Now that doesn't make sense though, because we're talking about the required ending inventory for this quarter, and the quarter ends in March. So our required ending inventory shouldn't be just the blanket total of the required ending inventory for January, February, and March. It should only be the required ending inventory for the month of March, because this quarter ends in March. Okay, so that's number one, which means the total required units for the quarter is 34,000 units that we're looking to sell during the quarter, plus 2,400 units that we expect to have at the end of the quarter. So that should be 36,400. Similarly, for the beginning inventory, it shouldn't just be the total of the beginning inventory for each of the months, but rather it should be the beginning inventory for the quarter. And recall, the quarter started in the month of January. So it's 2,200 units that we must have had as beginning inventory for this quarter. So how many units must we produce? 36,400 minus the 2,200, and that's 34,200 units, which, if we've done our arithmetic correctly, should equal the sum total of the number of units to be produced in each of the months. And it is indeed 34,100. Once the production budget is completed, we can move on to the raw materials purchases budget. The starting point for the raw materials purchases budget is the number of units that we'll be producing in each of the months. So we copy that information down. We're looking to produce a total of 34,200 units, and that comprises of 10,800 units for January, 10,600 for February, and 12,800 for the month of March. Now, since we are looking to calculate raw materials purchases, we need further information, and that is given to us in item C. The company purchases enough raw materials each month for the current month's production requirement and 25% of the next month's production requirement. This is again another example of the company willing to maintain a safety stock and not run out of important raw materials. Each unit of the product, though, requires 5 kilograms of raw material at $3.60 per kilogram. The $3.60 will come in handy when we calculate what the cost of the raw materials would be. But first, we must calculate how much of the raw materials we need. So each unit needs 5 kilograms of raw material. So for the units that we must produce in January, 10,800 multiplied by 5 kilograms, we will need 54,000 kilograms of raw materials just to produce the number of units required for January. Similarly, if we do this calculation for February and March, number of units multiplied by 5 gives you 53,000 kilograms needed in February, 64,000 kilograms needed in March, and a total of 171,000 kilograms for the entire quarter. Our required ending inventory of the raw materials, though, is 25% of the following month's production needs. So the month of January, we do need 54,000 kilograms just to get the product manufactured, but we also want to maintain an ending inventory of raw materials equal to 25% of 53,000 kilograms. That's how much of raw materials we will need for February, and we just don't want to take the risk of running out of stock. So we want to maintain an ending inventory of raw materials in the month of January equaling 25% of February's requirement. That gives us 13,250 kilograms. The total quantity of raw materials that is needed, therefore, adds up to 67,250 kilograms. Do we need to buy all of the 67,250 kilograms? Again, the answer is no, because we would expect to have a certain amount of beginning raw materials inventory. And just like I explained for the finished goods inventory, if this company really has been diligent in applying its policy of maintaining 25% of the following period's production requirements, the total quantity of raw materials required to meet January production needs is 54,000. 25% of 54,000 is what we expect should be the ending inventory. And let's check. 54,000 is the quantity of materials needed for production in January. 25% of that works out to 13,500. We should have 13,500 kilograms in raw materials. Let's go take a look in the case. What do they tell us? There were 13,500 kilograms of raw materials in inventory at the end of 21. So good. We can confirm that our expectations were spot on. 13,500 kilograms is already there with us. We only need to buy the difference. So 67,250 less the 13,500, we need to buy 53,750 kilograms, physical quantity. The cost per kilogram is $3.60. We multiply 53,750 with the $3.60. The dollar cost of inventory purchases to be made in the month of January works out to $193,500. And then the process continues. February, we need 53,000 kilograms for actual production in February, but we also want to make sure that we have on hand 25% of the inventory required for production in March, which gives us 16,000 kilograms. The total is 69,000 kilograms of raw materials required to be available. We will have on hand 13,250 kilograms. Ending inventory from January becomes the beginning inventory for February. So subtract that out of the total inventory required, we get 55,750 kilograms needed to be purchased in February, which at a cost of $3.60 per kilogram works out to $200,700 of purchases. Then lastly, for March, we will need 64,000 kilograms of raw materials to meet the production needs for March. But we also need to make sure that we keep 25% of the amount of raw materials that we will need to produce the number of units for April. And we don't know that. We don't know that number. We don't know how many units will need to be produced in April. So we'll have to retrace our steps and go back to the production budget. And if we take a look there, well, in April, the company is looking to sell 12,000 units. But recall that for finished goods, the company wants to maintain an ending inventory of 20% for the next month's sales. Now, the next month following April is the month of May. And in the month of May, we estimate 11,000 units will be sold. So 11,000 units are expected to be sold in May. Of that, 20% we would want to maintain as the ending inventory for April. So we need to have a total quantity of 14,200 units of finished goods for April. Of that, 2,400 representing the ending inventory from March is already there at the start of April. So the difference, 11,800, is how many units the company needs to produce in the month of April. This 11,800 we bring down to our raw materials purchases budget, multiply by 5 kilograms of raw materials needed per unit to get 59,000 kilograms of raw materials required to meet the production for April. Of this 59,000, we want to end the month of March with 25% of 59,000. That's 14,750 kilograms. So total quantity of raw materials required in March is 64,000 for production in March, plus 14,750, which is 25% of April's production requirements. We already have on hand 16,000 kilograms, which is our ending inventory coming from February. The difference is how much we would need to purchase in the month of March at $3.60 per kilogram. That translates to a total of $225,900. For the totals column, we need a total of 171,000 kilograms of raw materials for production in the quarter, January through March. But we also want to make sure that we end the quarter with 14,750 kilograms. That gives us total quantity required of raw materials during the quarter, 185,750. We already had at the beginning of the quarter 13,500 kilograms of raw materials. So subtracting 13,500 from the 185,750, we get 172,250 kilograms. And that should be the sum total of the raw materials required to be purchased in each of the 3 months. It is. Multiply 172,250 by $3.60, and the total dollar value of purchases to be made in the 3-month period is $620,100. Once we have determined our raw materials purchases budget, then the next thing that I suggest you do is determine what is the dollar amount that you'll be paying for such purchase. Because usually there are credit terms. So over here, we're told Garneau pays 40% of the raw material purchases in the month of purchase and the remaining 60% in the following month. So the implication is that there is no early payment discount. We pay 40% of the purchases in the month and then the remaining 60% in the following month. So what that means is that if you made a purchase in the month of January, right, we're looking to buy $193,500 worth in the month of January, we will be paying 40% of that in the month of January. So that's 40% of 193,500, and the remaining 60% we will pay in the month of February. The amount of materials that we're looking to buy in the month of February, we'll pay 40% in the month of February and 60% in the month of March. 60% of 200,000. And similarly, for the purchases that we make in the month of March, we will pay 40% in the month of March, and the rest will be paid out in April. We're not making a budget for April. Notice there's a 2-month pattern now. In March, we paid 40% of the purchases from March and 60% from the purchases in February. In February, we paid 40% of purchases from February and 60% of the purchases made in January. So by this logic, in the month of January, we should pay 40% of the purchases made in January and then 60% of the purchases made in December. Now, in the case, we were given the amount of accounts payable. The accounts payable for raw materials purchases are $124,740 as of January 1st, 2020. This relates to the amount of purchases that were made in the month of December. And so what we'll do is, because that number is given to us, we'll happily accept it and say, well, we got to pay that out in the month of January. You add things up vertically. For the month of January, we are going to be paying $202,140. In February, we'll pay $196,380. And in March, we'll pay $210,070. The total amount of payments to be made for raw materials purchases, therefore, for this quarter work out to $609,300, and that represents the sum of these total values. All right, so we have so far looked at the sales budget, we have looked at the production budget, and we have looked at raw materials purchases budget. And we also prepared the supporting schedules of cash collections from customers and cash payments for raw materials. Next, we move on to the direct labor budget. So for this budget, we need information about how much of labor time is required. So over here in information D, we are told each unit of finished product needs 1.5 labor hours. So if you multiply the number of units produced in any given month with 1.5, we'll get the number of direct labor hours for that month. And the average wage rate is $16 per hour. If you multiply the number of labor hours by $16, we'll get the direct labor costs for each of the months. That's a fairly straightforward calculation after the complex calculation we saw for materials purchases and the production budgets. So here we start out with the number of units to be produced, which we get from our production budget each month. Those are the number of units to be produced. Multiply by 1.5 labor hours needed to make each unit. So 10,800 times 1.5, that gives us 16,200 labor hours for February, March, and the total quarter. The wage rate on average is $16 an hour. So if we multiply the number of labor hours required by $16 an hour, we get the budgeted direct labor cost. And it would be a reasonable assumption that the company pays out wages as they get earned. So we'll make that simplifying assumption that in the month of January, we would pay $259,200. For the month of February, $254,400, and so on. We were also asked to set up the manufacturing overhead budget for the quarter. Now, manufacturing overhead consists of two pieces, the variable overhead and the fixed overhead. Now, in the case, we're told that the variable manufacturing overhead is 40% of the direct labor cost. So if that's the case, and we've just finished calculating the wage costs, we can multiply these dollar amounts by 40% to get the variable portion of the manufacturing overhead. So in the month of January, the variable manufacturing overhead is 40% of the direct labor cost for January. In the month of February, it's 40% of February direct labor cost, and so on. Now for the fixed manufacturing overhead, the fixed overhead costs per month are as follows. We have the factory supervisor salary, $15,000 per month. Factory insurance is $20,000 per month. Factory rent is $30,000 per month. And the depreciation of factory equipment works out to $12,000 per month. So these are the monthly costs. And by definition, fixed overhead doesn't change with volume of production as long as the production volume lies within the relevant range. So total cost is $77,000 in each of the months. And that's the total fixed manufacturing overhead. The total manufacturing overhead is the sum of the variable manufacturing overhead and the fixed manufacturing overhead. So if we look at the month of January, the number will be 180,680. For the month of February, it's 101,760 plus 77,000, and that's 178,760. And similarly, we get the month of March. For the totals, total factory supervisor salary is 45,000 over the 3 months. Total factory insurance is 60,000. Total factory rent is 90,000, and the total of depreciation of factory equipment is 36,000. So we have total manufacturing overhead calculated here as the sum of the variable manufacturing overhead and the fixed manufacturing overhead. And this is information that will be needed for preparing projected financial statements. But we also have to make a cash budget. And for the cash budget, we need to figure out the amount of manufacturing overhead that will actually be paid for in cash. And although our total manufacturing overhead for January is 180,680, we're not really going to pay that amount in cash. The reason is that included in the fixed manufacturing overhead there is depreciation. Depreciation is a non-cash item. So subtract $12,000 from the 180,680, and you get the manufacturing overhead that will be paid for in cash in January, 168,680. Do the same for the remaining months, and you get the amount of manufacturing overhead that will be paid for in cash for the month of February, March, and then for the total quarter. Some of you may be tempted to ask, okay, so if you're going to subtract depreciation anyways, why do we bother to include it in the first place, right? Why bother to include $12,000 of depreciation if we were going to subtract it anyways? And the answer to that is that depreciation, although it's a non-cash item, it is very much part of my manufacturing overhead costs. If I do not include depreciation, we'll end up with a wrong impression of the costs per unit for the manufacturing that occurred in the current year. So with regards to achieving full costing, we need to include the depreciation cost. However, for the cash budget, we exclude it. Next up, we will prepare a selling and administrative budget. So selling and administrative budget also has a fixed portion and a variable portion. If we scan through the information provided, we are given information about the fixed selling and administrative expenses. We have advertising, 2,000, depreciation, 3,000, insurance, 2,500, salaries, 20,000, and other selling and admin expenses are $15,600. Then we are told that variable selling and admin expenses consist of $4 for shipping. That'd be $4 per unit. It's not like all the units we sold cost us $4. That's $4 on a per unit basis, and 8% of sale or commissions. So these two are variable selling and admin costs. One more selling and admin cost that we shouldn't forget is the bad debt expense. So bad debt expense arose because we sold on credit people who didn't pay. Now, unfortunately, extending credit is normal business practice, and some people don't pay. Some companies purchase, some of our buyers will not pay as promised, and that is again part of the cost of doing business. So bad debt expense are seen as part of selling expenses. They are essentially losses, but they arise due to our um, credit granting policies, and they are related to the activity of selling. So because 2.5% of all credit sales was bad debt expense, we can clearly see that this is a variable number, and we need to calculate the bad debt expense and include bad debt expense as part of our variable selling and administrative expense. So easy part first, shipping is $4 for each unit sold. The number of units sold we can get from the sales budget, 11,000 in January, 10,000 in February, 13,000 in March. If you multiply each of those with $4, we get shipping expenses are $44,000 in January, 40,000 in February, 52,000 in March. For sales commissions, it's about 8% of sales. So if you multiply 8% with the sales dollars, the sales dollars were 825,000 for January, 750,000 for February, and $975,000 for March. 8% of these sales values, that gives us the sales commission. And then finally, the bad debt expense. Recall that the bad debt expense was 2.5% of credit sales. And since credit sales were 60% of total sales, 2.5% of 60% worked out to 1.5% of total sales. So using that 1.5% makes life a little bit easier for us. We know what the total sales dollars are. We can multiply the total sales dollars by 1.5% for each of the month to get the bad debt expense for that month. That's basically what you do here. Multiply the monthly sales by 1.5%, and that gives us $12,375 for January, $11,250 for February, and $14,625 for March. Sum them up and you get total variable selling and admin expenses for the months of Jan, Feb, March, and the total for the quarter. Looking now at the fixed selling and admin expenses, we were given some dollars, 2,000 for advertising, 3,000 for depreciation, and so on. But always be careful. Sometimes there might be additional information that's hidden elsewhere. An example of that is item J. The company will acquire assets for use in the sales office at a cost of $300,000, which will be paid at the end of January 2022. The monthly depreciation expense on the additional capital assets will be $5,000. You can see certainly the $3,000 depreciation that we've been given currently doesn't include the additional depreciation. So this is going to start. The monthly depreciation will start from the month of February. We are acquiring the assets at the end of January. Depreciation starts once the asset is ready for use. So our depreciation, the new depreciation of $5,000 additional, will start from February. So here we have to go with the initial amounts given in information number H, 2,000, 3,000, 2,500, 20,000, and 15,600 respectively. those will be our fixed selling and admin expenses for the month of January. But starting the month of February, our amount for depreciation will go up by 5,000. So from 3,000, it'll go up to $8,000. And will be the same for the month of March. We can add up horizontally to get the total fixed selling and admin expenses. The total selling and admin expenses is just the sum of the variable and the fixed selling and admin expenses. So month of January, that total is 164,475, and you can get the amounts for February and March. Of course, this total selling and admin expense includes non-cash items. Depreciation is non-cash, so we'll subtract out the depreciation, but also keep in mind bad debt expense is non-cash. It is an expense item, but we don't really actually pay out of pocket for bad debt expenses. It's just they simply represent the amounts that our debtors don't pay as promised. So subtract these non-cash items. Out of 165,475, subtract the depreciation and subtract the bad debt expense, and we get the selling and admin expense that will be paid for in cash, $150,100 for the month of January, and we can calculate the relevant amounts for the month of February and March. So thus far, we have done a lot of work, but we still need to perform a lot of work yet, and that is for the preparation of the cash budget. The cash budget tends to be one of the more challenging aspects of a master budgeting exercise, and it is important that we do this on an iterative basis. So what does the cash budget look like? As you can see on the screen, we start with the cash balance at the beginning of the period. So for the month of January, there'd be a certain amount of cash available. We can check the case, and we're told that the cash on hand on January 1st is $80,000. That'll be our beginning cash balance. The beginning cash balance for February, though, we don't know, because that will be the cash balance at the end of January. So we must wait until we've completed the process for January. To the cash balance beginning, we add cash collections during the month. Now this, fortunately, we have been able to calculate for all of the 3 months. Right? Our cash collection schedule, we had figured out that in the month of January, we're going to collect 831,750. For February, it will be 795,000. And for the month of March, it'll be 841,125, giving us a total collection for the quarter, 2,467,875. So in our cash budget, we can happily copy that information. And it's always a good feeling psychologically to see the numbers all filling up. For cash disbursements, cash payment for raw materials purchases, we had calculated that amount. Cash payment for raw materials, month of January, we said we're going to pay $202,140. Month of February, $196,380. And for the month of March, $210,780, for a total of $609,300. Well, bring that down. That's going to be one of the cash disbursements we are looking to make. For direct labor, we get our information from the labor budget. We had budgeted for $259,200 for January, $254,400 for the month of February, $307,200 for March, giving us a total of $820,800 to be paid for direct labor. We can copy that information down here in the cash budget. Likewise, cash payment for manufacturing overhead. We had calculated the manufacturing overhead payable in cash. total of 523,320. So bring that down. And the cash payment for selling and admin expenses, we had computed that to be $460,300. Bring that down. The only other payment that we're looking to make as per the case is the $300,000 that we will pay to buy capital assets for use in the sales office. This payment's going to be made at the end of January 2022. Sometimes you'll be given information about dividends that the company pays at routine intervals. Sometimes the company will be paying income tax installments. So those could be other examples of payments that will be required to be included in your cash budget, but they don't come necessarily from any of these earlier budgets that we prepared. So $300,000 is a payment that will be made at the end of January. So for the month of January, then, we would begin with $80,000 of cash on hand, and we expect to collect $831,050. It's going to give us total cash available of $911,750. So sum of beginning balance plus the cash collections. Now, if we look at our cash disbursements, disbursements is just a fancy word for cash payments. Cash payments in January will add up to over $1 million. Now, certainly we don't have enough cash available. That means because our payments are expected to be higher than the cash available, the company is going to be in a position of cash deficiency. It's going to be deficient $168,370. And this means we will have to go and borrow money to make up our cash shortfall. So for that, there's information provided, additional information. All cash payments except purchases of raw materials are made monthly as incurred. That's good to know. We've already captured that path. If we need to borrow, all borrowings must occur at the beginning of each month. Now, this is not representative of real life. This has just been, this condition's been inserted to make sure that we all will get the same answer. We are forcing this to happen. We are forcing all borrowings to occur at the start of each month, and all repayments, if they were to occur, will happen at the end of the month. This is not reflective of real life, because in real life, cash inflows and outflows can happen anytime. We are forcing the issue here to achieve consistency for all persons performing the math. And another non-real life scenario is that borrowings and repayments can occur only in multiples of $1,000. That too is not reflective of real life, but we are going to force this on our case. All interest on borrowed funds is paid at the end of each month at the rate of 0.5% per month. So there's interest to be considered. And a minimum cash balance of $25,000 is required at the end of each month. So we can't borrow just enough to make up our cash shortfall. We need to make sure that we end the month with at least $25,000 on hand. So this does force our hand considerably. We need to do a little bit of math here for how much the company needs to borrow. And I've shown the financing as note 3. So if we have a cash deficiency, and that's the case for January, start with the amount of the deficiency. Well, how much are we deficient of? We are falling short by $168,000. So in order to cover that deficiency, we need to borrow $168,370. Now, what if there was a beginning loan balance? What if the company had already borrowed money? Well, then we would have to factor in interest on that beginning loan balance. There's nothing stated in this case about a beginning loan balance. So in our case, that's not applicable. Now, borrowing 168,370 will only help us cover our deficiency. We need to make sure that we end the month with at least $25,000 of a cash balance. You need to borrow that as well. So add the minimum cash balance required. Adding up the deficiency, any interest on a beginning loan balance, if there was, and the minimum cash balance required, gives us the total cash that this company needs to have available for it to use. Now that total is 193,370. The problem though is that if the company borrows $100, the borrowing needs to happen at the beginning of the month. Well, if you borrow $100 and that has to be done at the start of the month, we'll need to set aside some money to pay interest on what we are borrowing, because interest gets clocked at 0.5%. So 0.5% of $100 is 50 cents. So the issue is that if we were to borrow $100, we can only put to use $99.50. The remaining 50 cents for every $100 borrowed has to be put aside for paying interest on what you're borrowing. So if this company is looking to use $193,370, it actually needs to borrow $193,370 divided by 99.5%, right? For every 100% you borrow, you got to put aside 0.5% for the monthly interest. So the amount to borrow is 193,370 divided by 0.995. So if we could borrow any amount that we required, this is the precise amount to borrow. 194,342 is the precise amount that you would have to borrow. Let's check. If we were allowed to borrow $194,342, 0.5% interest would work out to $972, just rounding to the closest numbers, 972. So 194,342 minus $972 of interest, well, it lets us use the 193,370, right? We will be able to have exactly the amount that we need. And if that were possible, if we could borrow the $193,342, we would, if we could borrow that amount, then we would have 194,342 borrowed. The interest would be 0.5%, so 972. Net borrowing will work out to $193,370. Our cash balance at the end of the period is the cash excess or deficiency plus the total financing. We add them up, we have a deficiency, that's a negative balance, and you add to that the total financing of 193,370, and voila, we would have exactly $25,000 left. The problem, though, is that we are not permitted to borrow any amount that we would like. We can't do that. So what we must do is we need to round up to the next 1,000 whole dollars. So $194,342, if you round it up to the next whole thousand, we will have to borrow $195,000. And the only reason for that is that our hands are tied. We are told explicitly that borrowings can only happen in multiples of $1,000. So if we try to borrow 194,000, we'll fall short still. So we got to borrow to the next higher $195,000. So borrow $195,000. If you do that, if you borrow $195,000, we're not able to repay anything. In the month that we are borrowing, there's no way that we can repay any of the principal. We'll have to pay interest on the $195,000 that we borrowed, 0.5%. Our total financing in this case will work out to $194,025. Our cash balance at the end of the month of January, therefore, will be the sum of the deficiency, which is a negative amount, and the financing, which in this case is positive because we borrowed money in the current month, will be left with $25,655. Now notice that we were told that a minimum balance of $25,000 is required, right? And we have achieved that. We have more than $25,000. And the reason we have more than $25,000 on hand is that we were forced to borrow more cash than we actually needed. So continuing, the ending cash balance for the month of January becomes the beginning cash balance for the month of February. In the month of February, we expect to collect $795,000 from customers, giving us a total of $820,655. The total cash disbursements for the month of February add up to $757,640. So now we're looking at a cash excess because we have more cash available than the cash disbursements. So we have a cash excess of $63,015. So now we look at our financing. Now that we have cash excess, start with the excess, $63,015. And the first thing you want to set aside is the interest on the beginning loan balance. So for the month of February, there is a beginning loan balance. We didn't calculate that for January. Let's go back and do that. There was no information about any loan balance at the start of January. So we started with 0. And then in January, we ended up borrowing $195,000, paying nothing. The loan balance at the end of January, therefore, was $195,000. The ending loan balance from January becomes the beginning loan balance for the month of February. And recall, any repayments can only happen at the end of the month, right? Any repayments are forced to happen at the end of the month. So if we owed any money at the start of the month, we will have to pay interest on it at the rate of 0.5%, right? So since we have a beginning loan balance of $195,000, we have to set aside 0.5% of $195,000 or $975 to pay the interest. From $63,015, we got to first take out $975 of interest to be paid on the beginning balance of the loan. But that's not all. We are also forced to maintain a minimum cash balance of $25,000. So you have to put that aside as well. So once you take out the interest on the beginning loan balance and the minimum cash balance required, what you're left with is a potential to repay to the tune of $37,040. That is the amount of cash that we have available to repay if we were allowed to repay in any amount whatsoever. However, our hands are tied there as well. All repayments can only occur in multiples of $1,000, unless, of course, you're repaying the entire loan balance, in which case it will be fine to have a fraction of $1,000 being repaid. But that's not the case here. We owe $195,000. So certainly $37,040 is not going to wipe out our entire amount of the loan. So in terms of what is our maximum ability to repay, The maximum ability is calculated by rounding down the amount to the lower multiple of 1,000. So round down. It doesn't matter here that it's $37,040. Even if this number was $37,940, you still could not repay 38,000 because that'll result in our ending cash balance dropping below 25,000. So the only option available to us is to round down. And so you round down to 37,000. You're going to repay $37,000 in February, leaving us with a loan balance of $108,000. In the financing column, we don't borrow anything in February. We in fact repay $37,000 and also the interest, $975. Total financing for the month of February, therefore, is negative $37,975. My ending cash balance is the total of the cash excess and the financing, and that leaves us with $25,040. $25,040, therefore, becomes the beginning cash balance for March. In March, we have total cash collections expecting to be $841,125, the total of which gives us $866,165 of cash available for use. The cash disbursements add up to $875,960. Uh-oh, we're again looking at a cash deficiency. This time it's a deficiency of $9,795. So once again, it's time to calculate how much to borrow. Here, we start with the deficiency, that's $9,795. That's how much we need to borrow to just wipe out our negative cash balance. We do have a beginning loan amount of $158,000 that's brought forward from February. And recall, we have to pay interest at 0.5%. So 0.5% of that 158,000 beginning loan balance we need to provide. And there is the issue of making sure that we have a minimum cash balance of 25,000. So all in, we need cash amounting to $35,585 that we should be able to use. Again, because we are forced to borrow at the beginning of the month, we'll have to put aside 0.5% of whatever we borrow towards interest to pay on the sum that we are borrowing. We will need to borrow 35,585 divided by 99.5%, a sum of $35,764 exactly. But that too is not possible. We can't borrow 35,764 because we're told that all borrowings need to happen in multiples of $1,000. So the next best thing is to round up to 36,000. We're going to borrow $36,000. There's no repayments. The total interest we'll end up paying is 0.5% on the beginning loan balance, and then 0.5% on what you borrowed in the current month. So that adds up to a total of $970. Net financing is $35,030. The cash balance at the end is the cash deficiency, which is a negative amount, and the financing, which is positive because of borrowing. We would be left with $25,235 on hand. Our loan balance will grow to $194,000. Okay, now the totals column, recall that you cannot simply go ahead and add together the beginning cash balances for each month. Our beginning cash balance for the quarter is $80,000, the beginning balance from the month of January. Remember, the quarter runs from January to March. The total cash available, therefore, is 80,000 plus the cash collections in the quarter. Don't just add together the total cash available, because that's going to involve double counting of the beginning balances. Again, don't do that. The total payments are basically horizontal sums across the board. And then the total amount of cash disbursements is 2,713,070. For this quarter, then, our total cash shortfall deficiency will work out to 2,547,000 minus the 2,713,000 that you're seeing there. And that amount works out to 165,845. That is our deficiency for this quarter. Now, in terms of financing, we borrowed a sum of 231,000 during the quarter, repaid 37,000, and we paid interest, cash interest of 2,920. The total financing, therefore, is $191,080. Our cash balance at the end of the quarter is the cash deficiency for the quarter plus the total financing for the quarter, and that works out to 25,205. Notice this is exactly the same as the ending cash balance for the month of March. This is a very important check figure. Your numbers should match. Otherwise, some mistake has certainly been made. So this concludes our discussion of case 929. This was a fairly long affair. I would recommend that you try to work along as much as possible. Pause the video at strategic places that you can get caught up. And I hope you'll find this useful when working on your master budget assignment. Thank you for watching.